Alright, so today I wanted to make a video on a post that I made the other day. First things first, if you get value out of this video, please like and subscribe. Really appreciate that. So I go on to say, there are 3 ways to gain an edge as an investor. Number 1, luck. Number 2, smarts or intelligence. And number 3, patience or discipline. And this is very important because to be a good investor, you need to understand this stuff. Because if you do not have the patience nor the discipline to be good, but your entire investment philosophy is I'm just going to, invest in index funds and wait 30 or 40 years, but every time the market goes down 2%, you panic and go to cash or panic and sell or just stop buying, you're not going to be successful because your entire premise behind your philosophy it's wrong. It's not going to work out. And the same thing goes with smarts and intelligence, in that a lot of people think that they're a lot smarter than they are, but they're really not. So if you're relying entirely on smarts or intelligence, unless you have something that other people like, unless you have a distinct advantage, like I don't know, you work at one of the largest hedge funds in the world, or Warren Buffett's your best friend, or something along those lines, right? It's kind of hard, right? It's kind of hard. And the most important point that I wanted to drive home when it comes to this video is it's impossible to rely on luck over the long run. Technically, you could say, oh, if you just find the right stock and you're allocated aggressively, then that might be enough. That's true. But is that realistic for most people? No, that really isn't. There is one thing that anyone can do that guaranteed will give them an edge or an advantage. And that is simply be more patient than the average person. Be more disciplined than the average person. And what I mean by that is, number 1, you don't care about whether the market's up or down, whether the market is cheap or expensive. You're constantly looking for value. Or if you're simply an index investor, you just buy no matter what. Now again, if the market's at once in a generation multiples, maybe you can say, okay, maybe it's time to stop buying. But when it comes to humans, most people are too emotional to be making these kinds of decisions. Most people cannot rationally do it. And it hits them on both sides, right? When the market's up, it's like, oh, right now, it's like, oh, it's too expensive. You shouldn't be buying. You should sell and hold cash, right? Or on the other hand, it's when the market's down, it's like, yep, we're going to see this massive recession. It's going to be 2008 all over again. Stocks are going to be down 50%, and you're going to lose it all, and blah, 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 blah. And both of those are overreacting. Both of those are overreacting. If you're a long-term investor, it should not matter to you whether or not the market's up or not right now. And if you've been buying for 20 or 30 or 40 years, it shouldn't really matter all that much either, because you're probably up so much that it's like, okay, well, you're up 1,000% versus 950. Like, do you really care? Like, okay, maybe a little bit, but it's not the end of the world. It's not the end of the world at all. And my entire philosophy when it comes to my channel, is specifically the investing side of it, is I'm a long-term investor. I'm in my 20s. I don't care about short-term fluctuations. All I care about is where are we going to be at 10, 20, 30 years from now. And if we have, let's say over the next year, the market's down 30%, yeah, we'll remember it, but nobody's really going to care all that much. So that's the big thing here, is that the most important characteristic or trait you can develop as an investor is to be more patient and disciplined than other people. Finding the best stocks, finding the next Nvidia. This is something people talk about all the time, or the next penny stock that's going to go up 10 or 20 times. That's not that important. The most important thing is when the market's way down, can you have the discipline to be buying? And when the market's way up, can you have the discipline not to think that it's going to continue to go up in a straight line, but to still find the value in the market and to not sell and sit in cash. That's where that's where we separate the men from the boys. That's really the most important thing. People talk all over Warren Buffett this, Warren Buffett that, but the most important thing that people don't bring up when it comes to Warren Buffett is he's been consistent over like 70 years, right? Like when you look at Warren Buffett, 99% of his wealth has came after the age of 50. And like 95 was like after the age of 65. 95% of his wealth has been generated after he was a senior citizen. And this is not talked about enough, because it's not that he found all the Nvidia type stocks and just piled a bunch of money in. That's not what made him successful. What made him successful is he was just more patient than the next guy. He was willing to wait decades to be right. So that is the main point I wanted to drive home here, is patience and discipline is the most important aspect of investing. It's not finding the best stocks. It's not, whatever. It's not finding the best way to trade. It's not figuring out how to time the market. It's discipline. And the last thing I'll bring up here is smarts or intelligence definitely is important. Like when you look at these top investors, they definitely find a lot of good companies, like kind of these diamonds in the rough, or these companies that are beat down but are going to come back. They definitely do that, right? And that's important. It's important to find out, what's a good company, what's a bad company. I talk about that a lot. In fact, that's what I talk about the most. But the most important by far is still having that patience, having that discipline. And oftentimes they go hand in hand. Like what I've said time and time again is that you always want to have a very active watch list. Like I manage my watch list more actively than I manage the stocks that I actually own, because I want to know which companies are good companies. That's simply what the watch list is. And then the most important part is monitoring those valuations, because whether a company is a good investment or not depends on two factors. It depends upon, is it a good company? And number two, is it a good price? Because you look at a company like Nvidia, I think it's a really good company, but it's way too expensive. And you also have to keep an eye on the flip side too. There's a lot of people that make the mistake of like a Walgreens or a company like that. Like, it's a good price, it's really cheap, but it's not a good company. So you have to find a way to combine those two things. You have to find a way to combine those two things. Obviously, that's somewhat up to interpretation, at least to some degree, but you need to find a way to combine those two things. And that's my entire investing strategy, is figuring out number 2 and number 3 on this list. Number 2 is it a good company? Finding out if it's a good company. Number 3 is it a good valuation? That is bringing what I brought up right at the start full circle. So anyway, if you got value out of this video, please like, subscribe, comment, all that good stuff. Really appreciate that, and stay tuned for more.